Good morning, ladies and gentlemen. Good afternoon to those who have connected from the Far East. Welcome to National Development Bank PLC's quarterly investor webinar. This webinar is dedicated to discuss the bank's financial performance for the financial year ended 31st December 2024. Today's webinar follows the same format like all our prior webinars, where the bank's Director, Chief Executive Officer, Mr. Kalum Edrisinghe, will take you through a prepared presentation, at the end of which he will open the forum for questions from the participants. During the Q&A, he will be joined by a panel comprising Mr. K.V. Vinod, Deputy Chief Executive Officer, Mr. Sanjay Pereira, Senior Vice President, Personal Banking and Customer Experience, Mr. Alex Pereira, Vice President, Chief Risk Officer, Mr. Damita Samaranayaka, Vice President, Treasury, and Ms. Himali Nandika, Chief Manager, Finance. All participants are kindly requested to remain on mute with your video switched off throughout the presentation and the Q&A session. Please use the chat option to present your questions to the panel. Please note that this session is being recorded for a playback video and an edited transcript to be uploaded to the bank's website subsequently. On those detailed notes, let me now hand over the proceedings to the CEO. Thank you.
Thank you, Kumudari, and good morning and good afternoon to everyone who's joining this webinar. First and foremost, I would like to present our summary of performance for the full year 2024, starting with an impressive PBT growth of 141%, settling at 24.3 billion. Needless to say that this number has certain one-offs arising from the ISB restructure. But other than that, on a reported or underlying basis, we still reported a strong profit growth of 28% year on year, settling at 12.8 billion rupees. Staying consistent with the commitments that we made at the beginning of the year, where we wanted to concentrate on driving our driving our NIMs, I'm happy to say that our NIM for the year ended 2024 settled at 4.34%, 38 basis points higher than the previous year. Similarly, we had a good performance with regard to our fees and income, settling a little below 8 billion, or precisely at 7.8 billion rupees, again reporting a 9% growth year on year. Coming to the asset quality, again, something that we were really focused on in 2024, I think it is now clear that we have made very good progress, where the stage 3 loan ratio dropped to 14.01% compared to 16.64% for the year ended 2023 December. And this is an area that we will continue to remain focused, and I'll talk about these numbers later on in the slides. Last but not least, looking at our return on equity, we were able to report 12.2% coming into the mid-teen returns compared to 8.03% reported in 2023. Let me now take you through some of the numbers. Starting from gross income, we reported a 25% degrowth, and this is very much in line with what the market reported, with different banks reporting degrowths between 20 to 30%. So the 25% degrowth that we reported is pretty much in line with the market. And this is mainly as a result of the low interest rates that remained during the period. On total operating income, NDB reported a modest growth of 1%. But when you look at, again, across the market participants, our 1% growth is actually much better than the reported numbers of other participants, which by and large was a degrowth. There are some notable items here as well, and if I'm to just take the impairments. So we reported an impairment reversal of 9.9 billion rupees, made up of two things. Firstly, on the loan impairments, we booked an additional charge of 13.2 billion rupees for the year. This is further discussed under slide 7. On ISBs, there was a reversal of 23.6 billion rupees discussed under slide 10, resulting in a 9.9 billion rupee net reversal. On the debt restructuring, there was an impact of 14.3 billion rupees. This again is discussed in detail on slide 10, and we can go to that later on in the slide. Our operating expenses reported some 23% growth year on year, and this is pretty much in line with what I presented in my previous webinars. And this is largely as a result of pay increases that we have given to staff. So there are no exceptional or underlying items that we hadn't planned for. Contributing to all the above that I have said, we reported a 24.3 billion PBT for the year, 141% growth as I said previously, and a profit after tax of little over 9 billion rupees. It is also a noteworthy, I must also mention that our total group profit settled at 9.7 billion thanks to the strong performance of our subsidiary companies contributing to the bottom line. In fact, their contribution was the highest during the last 10 years. With regard to assets and customer deposits and the balance sheet structure, there are further slides in the deck, and I will discuss about these numbers more in detail as we come to those slides. Building on from the discussion or the points that I made earlier, staying committed to what we said in our previous town halls, NIM was something that we really wanted to focus, and we are now seeing the benefits of that. And as you can see from the chart, starting from a little over 3% in 2020 to come to 4.34% in 2024. In addition to repricing our deposit book to stay in line with the market and also to drive NIMs, I must also mention that we have made some very good progress on building low-cost deposits in the form of CASA, increasing the CASA ratio from 22.6% in 2023 to 24.9% for the year ended December 2024. This is further detailed under slide 11. On the non-fund based income, so again we have made a good progress on this one with a growth of 9%, but obviously this also has some one-off items coming from the ISB restructure. And also just to draw your attention to other operating income, the negative 1.3 billion, that also has a foreign exchange reserve loss to the tune of 1.6 billion. So again, we have discussed this in our previous webinars as well. That is the revaluation of our FCBU balance reserves, and this is something that we have taken note of, and no appropriate action will be taken as deemed required. Coming to the credit quality and impairments, this is a very good story that I want to share, and again to emphasize on the point that I made earlier of the three midterm strategic priorities that we had. Driving asset quality was one such priority, and as you can see from the numbers, our impairment charges for the year ended 2024 was some 17% below the number of 15.9 billion that was reported in 2023. What is also worthy of note is that thanks to the efforts that we deployed and hard work of my team, we were able to reduce our stage 3 stock to 14.01% compared to 16.6% in 2023. Our impairment cover on the loan book also has improved in line with that. But again, to draw your attention to the last line, where our stage 3 loan cover, where it has improved to 54.48% from 41.1% in 2023. So we built up provisions to cover our downside risk, and it has gone up by 13.37 percentage points. And what is even more noteworthy and important to take cognizance of is that despite building that level of provision cover, our underlying PBT reported a 28% growth year on year, which actually gives credibility to the soundness of the business, and also the strong trajectory that we have for the future in terms of our loan growth. Coming to operating expenses, operating expenses was up compared to the previous year by 23%, and bulk of it actually comes from personal expenses. And again, this is something that we took note of, and this is in line with our projections, coming largely as a result of pay adjustments that we gave to staff. It is also worth noting that our cost to income ratio is the second best in the market, with some of the other banks at around 40% compared to NDB's 36.9%. On taxes and profitability, this slide is quite self-explanatory. The banking sector is a significant contributor to the government tax revenue, and again, we have contributed something to the tune of 9.7 billion rupees in 2024. So this is a slide I believe would attract a bit of interest from everyone who's on the call. So just to give a brief summary of the impact of the ISB restructure. So as it's shown in the slide, impact of the debt restructure actually is 14.3 billion. That is made up of two components, the day one loss and loss on the haircut, which is 10.7 billion and 3.5 billion respectively. So the reversal on ISB impairment, which is 23.7 billion, which had a net impact of about 9.9 billion, which I spoke earlier in terms of the net reversal. But again, the important point to note here is that year-on-year growth from the underlying operations was still a very strong 28%, which again, something that we are really proud of. So there are obviously a lot more details about the ISB restructure, and we have made a full disclosure in our annual report. And for those who want to get more information, I would recommend and I would encourage you to read annual report, page 288 and page 290 to get further information. So on customer loans and deposits, on the face of it, we are seeing a bit of a muted growth. So that is at 3% each on both loans and advances. One of the reasons for this is NDB actually has a fairly sizable dollar or other foreign currency book on both loans and deposits. So we saw a period where there was a material improvement in the rupee. I think coming down to about 295, 294 level, or even lesser, come from about 300 levels, which resulted in the translation loss as we have shown here. So, but taking that aside, we have on a constant currency basis, we have actually shown a strong growth, and this is something that we have taken note of. But I think that it's fair to say that that's something that is market driven, but underlying growth we remain very positive about. And as I said previously, our CASA ratio, which was at 22.6%, has increased to 24.9%, and this is again an area that we will continue to focus on as per our strategy to broad base our deposits, as well as to drive margins and increase our bottom line. On capital, anchored by the positive performance we reported in 2024, we are in a very strong position as the numbers show here, with capital very sound and being able to support our future growth. I'm again not going to read the numbers. This again is a testament to the hard work that we have done to both preserve capital and generate internal profits and contribute that to the soundness of the bank. I just want to also mention the debenture raisings that we did per the commitments that we have made to the market as well as to the regulator. So this was done in two tranches, 5 billion each, coming at 13.25% and 13%. On the dividends, I'm again happy to say that we made a dividend declaration of 8 rupees, comprising of a 5 rupee cash dividend and a 3 rupee scrip dividend. So just to give a bit more context to this, so our dividend yield as shown in the slide was 7.06%, and we distributed almost about 37% of our retained earnings to the shareholders. Again, a point to note is that that's the second highest in the market in terms of the dividend distribution, and keeping in line with what we want to do with regard to improving shareholder wealth, we will continue to look at a stable dividend in the coming years as well, depending, of course, the performance of the bank. So the key ratios are, our share price obviously ended up at 113%, almost double compared to 2023. And our ROA returned to mid-teens to 12.2%, and also our price to book value to 0.61 compared to 0.37 in the previous year. Our liquidity positions remain fairly strong, as can be seen here. So again, giving us a good foundation to build on for growth in 2025. Number of awards won by NDB, over 30 in 2024. Again, this validates the brand value that we have in the market, and what we contribute to, or rather our contribution to the economy. Again, this is something I'm immensely proud of, and there is a strong team behind all this work that has gone into it. So again, we will continue to play our part in being a good corporate citizen in 2025 and beyond as well. So just to sort of bring the presentation to a close, with strong capital liquidity and the corrective measures that we have taken on improving our stage 3 books and building impairments, we remain geared for growth. We are optimistic about the future, and we want to play an active role in supporting the economy. On number 2, as I said previously, we remain focused on driving top line growth, managing our cost, and making the organization an efficient one, thereby making a bigger contribution to our bottom line, and which will enable us to deliver a sustainable dividend as well as improve our price to book value. The third point, it's obviously it's self-explanatory. This is an area that we will continue to focus on. Currently, we are at 14.01% in terms of a stage 3 book. Our medium term target is to reduce this to a single digit. So that's the presentation, the brief presentation. We have included several slides giving our trends and additional data, which will be uploaded to our website. So that's the presentation I have for you. But before closing the presentation and handing over to Kumudari to take questions, I want to extend a big thank you to my leadership team for providing me the support in 2024 to get to where we are, as well as to all members of NDB for playing their part and making a strong contribution. So I want to thank all of them, and I'm looking forward to even a bigger contribution and a bigger impact in 2025. Kumudari, over to you.
Thank you, Kalu. Participants are now welcome to pose your questions using the chat option. We've received the first question, which is on impaired loans. The reported impaired loans, the stage 3 loans to total loans ratio is 5.18%, but when calculating impaired loans of LKR 39.5 billion to total loans 510 billion, the percentage is 7.7%. What's the reason for the difference? Do you only consider individual impairment? If so, why? I think this is a question surrounding the calculation in arriving at the impaired loans to total loans ratio. Himali, perhaps
calculating the impaired loan ratio, we have to consider the loan commitment as well. That's coming from the central bank guideline. The definition says the outstanding exposure plus the commitment we have to consider. That's why the 5.18% with compared to the calculation of 7.7. The difference between those two ratios are due to the commitments.
Thank you. This is a more forward-looking question which I would like to direct to Callum. What is the targeted level of CASA, NIM, loan book growth for 2025? CASA, NIM and loan book growth for 2025.
Yes. So, I mean, obviously, we have made some good progress with what we have done in 2024. Our target is to get to about 30 level in the medium term, but that may not necessarily happen in 2025. So, on the NIMs, in a low interest rate environment, delivering a NIM of 4.3-ish is going to be a challenge, but our target is going to be maybe between 4 to say 4.15 for 2025. On the loan book, I don't want to give a forward-looking forecast in that sense, but what I can say is, given the low interest rate environment and the government's push to make consumer demand more, which will hopefully give a bit of a stepping stone to grow loans, we remain confident on that, and we have put some numbers with regard to the available capacity and also estimating what the growth might be, and we will work on those numbers.
Another forward-looking question, perhaps Vinoj can take this up. Can you talk about your expectations for credit growth, which was partly answered for 2024, and from which sectors are you seeing this demand coming from?
So we expect the credit growth to come from mainly on the SME and maybe on the retail side. Because the corporate growth I'll talk about the next 2 quarters, meaning this quarter, next quarter, the corporate credit growth probably will remain muted, maybe in the first quarter, maybe it will pick up in the second quarter. But we are very bullish about the SME sector and maybe on the retail side. And having said that, on the project finance also, we have seen a strong pipeline. The approvals are ongoing, probably the disbursements will happen maybe in the second quarter.
What are your expectations on interest rates moving forward? Damita, if you could take that, please.
With the current inflation, which is it's at the deflationary level right now, and the central bank is also trying to maintain interest rates below 5%, and with that and the prevailing excess liquidity, and also the central bank's intention to buy into dollars from the market, that will eventually release more rupees into the market. So with all those things, I don't see any pressure on the interest rates in the near term. I would say within 2025, there's no much of a reason for interest rates to push higher.
The next question has 2 parts. The first one I will direct to Vinoj again. How has been the demand for LCs in 2025 thus far?
So again, I think it's pretty much what the demand was in the last quarter of 2024. We have not seen a major increase. I mean, if the specific question is mainly on the vehicle imports, we have had a share, I think, in comparison to our market size. But I wouldn't say it was a exponential growth compared to the last quarter of 2024. So it remains very much the same like last year.
Sanjay, if you could comment on how much of the loan book do you expect to be driven by the leasing growth?
Yeah, definitely it will be a significant growth. All this time when the imports were curtailed or stopped, we went on the accommodations for the existing leases. But now with the new imports coming in, we expect that to grow significantly. So we are also focused on getting the maximum market share possible.
Is the project loans still a major part of the NDB's book? If I may comment on that, it's about 20%. And the more detailed slide set that we will be releasing to the bank's website will have a sector-wise, or rather a business segment-wise classification of the loan book as well as the deposits book. The private credit in the industry fell month on month in January. What's your take on this? Did NDB see a degrowth in January as well?
So maybe let me take that, Kumudra. I think for the month of January, as far as the bank is concerned, we saw some growth, but it is not, it's not a huge amount. I think, this is in line with what the other market participants are experiencing as well.
Okay, let me direct the next question to Himali, which is on taxes. How much of deferred tax was reversed regarding ISB, and did it get charged as a tax expense in the income statement?
7 billion is the deferred tax asset that we reversed due to the ISB restructuring, and also that has been booked in as a charge to the P&L.
Himali, this one is also to you. What was your ISB related deferred tax asset reversal?
Yeah, it's the same, question.
Yes.
Yeah, 7 billion.
Okay. What is the buffer that the bank like to have in both tier 1 and tier 2 ratio?
So let me take that. I mean, we don't necessarily put a percentage as such, but we want to make sure that our capital buffers are strong to support growth as well as to withstand any shocks. And as I said in my slides previously, we are in a good position, and that should augur well for our growth in the future.
Himali, this one is for you. The stage 3 impairment provision grew and stage 1 provision fell in 4Q24 despite the loan growth. Any reason for the increase in stage 3 loans? Is there a movement between stage 1 to stage 3?
Stage 3 actually based on the status and the condition, economic and the customer status, we have recorded the impairment provision for stage 3 wherever required. In the stage 1 to stage 3 to 1, if you can see the stage 3 ratio, you can see a reduction in the ratio from 16% to 14.01%. So there is the movement from stage 3 to 2 and 1 also. So the stage 3, yes, we have done the build-up in the provisions where required. And stage 1, there is a movement from stage 3 to 1 as well, since the stage 3 has been reduced from 16 to 14%.
Alex, perhaps you can take the next one. Given the improving macro conditions, have you changed your PD assumptions in your impairment models?
So the ask is to benchmark some of the macro projections that are given by IMF, CBSL, and also the market in terms of the interest rates. So we are sticking to those assumptions, and on the scenarios, yes, we have made certain changes, especially given the outlook being relatively positive to the time period that we had in the last couple of years. So those scenario weightages have been changed accordingly.
Okay, Vinod, this question is over to you. What type of project loans is NDB concentrating on? Do you see an uptick on this post-elections?
Not really post-election, but I think our consideration have been like mainly on the renewable energy sector, but we are also looking at maybe some overseas projects which probably will get dispersed, like I said in my previous comment, which are now being getting approval and already approved, and maybe disbursement will happen in the next quarter. But our concentration mainly have been on the renewable energy and the energy sector. But I won't say it is post-election, but it has been there in the last 2 quarters.
Kalum, I will direct the next question to you. What initiatives has the bank taken to reduce outstanding NPLs?
Yeah, so I mean, that is actually remaining focused in what we want to achieve. So we have our recoveries department as well as a remedial unit, and we are working with the customers to give the right solutions, and they can come out of the challenges. So the simple answer is, really being focused on giving solutions to customers based on their own needs and continuing them through the recovery process.
Would you expect a significant impairment moving forward with loan growth, or should the impairment charge remain relatively flat given the bank has a strong provision coverage now?
So let me take that, and I think again staying consistent with what we have said previously, improving the quality of the book remains one of our key priorities that you can that can be seen in the numbers. What we have done during the year is to ensure that we have sufficient impairment cover, and we believe that we have come to that level of almost close to 55. So putting these two together plus the more positive economic or the macro environment, we are confident that we have got the quality of the book under control, and we don't necessarily see a significant spike in our stage 3s or the migrations for that matter.
Why did the net fee and commission income increase significantly in 4Q24? Do you expect it to maintain at that level in the next few quarters?
So I'll take that, and again I briefly mentioned this. So there is a ISP consent fee that is included in it, and this was also mentioned in the relevant disclosures that was issued by the government, and that came to about 1.7 to 1.8. So the fee amount is also enhanced as a result of this one-time payment.
Himali, this one is for you. How are you accounting for the new step-up bonds that you got as a part of the ISP exchange? Are they in held to maturity or HTM?
Yeah, it has been classified as the amortized cost, previously called as HTM, and under the stage 2. That's how we have booked.
One more for you, if you could take this one, please. What is the impairment provision made on the new USD bonds issued, replacing the former ISB loans?
So I think maybe I'll take that. I think some of these disclosures would be made in our audited financials, so I would recommend you to just have a look at some of our disclosures.
Okay, the next question, I think we will take this offline. The question is a little deeper explanation on what CBSL considers commitments in calculating the stage 3 to total loans ratio.
Yeah.
I'm afraid I cannot see the person who's posting this question right now, but we'll be happy to take that offline. Please do connect with us. What are the key targeted sectors for lending in 2025 for NDB? I think we answered that question. Can we comment on the fixed and floating breakdown in the loan book?
So again, I mean, this probably is not something that we disclosed, so that we'll have to remain at the levels of disclosures that we make.
There is a question on the average maturity of the current deposit base, I think, again, which is something...
But what I can say is that if the central bank has published this data to some extent, if you look at the banking industry, the general trend has been, at least in the recent past, is for the deposits to stay on the short term. So if you look at that as a general yardstick, it's not very different to NDB's position is not different to what the market is experiencing.
Callum, this one is also to you. The government is pushing for consolidation in the banking sector again. Are there any potential mergers or acquisitions on cards?
At the moment, no. But if there is a plan in the near future, we will make the necessary disclosures to the market.
We've come to the end of the questions. We will perhaps wait for a few more seconds to see whether there are any last-minute questions coming in. I think we've come to the end of the questions from the participants.
Thank you, and maybe
Yes,
we could bring
yes,
the
I think we can wrap it
webinar
up.
to an end.
Yes.
Yeah, thank you. Thanks to all.